Let's talk about some implications on buying a business in today's interest rate environment. And then we're going to give you some strategies to think about when you're looking for deals, you're looking for partners and negotiating the terms that maybe can help make you feel more comfortable in this interest rate environment that we're in right now.
In today's economy, more people than ever are looking to buy and sell businesses. But how do you do it? Welcome to the Deal Board, presented by Transworld Business Advisors. Straight talk about real deals and real people. Listen to stories, interviews, and expert advice to help your business sale, merger, or acquisition process. Now, here are your business exit experts, Andy and Jessica.
Hey, welcome back, everybody. And today we're talking about a very timely topic and one that's near and dear to us right now because interest rates are going up. And there's a lot of people are concerned about it. And although we're not extremely concerned about it, but it is certainly something that is changing the dynamic and changing the calculations, right, Jessica?
Yeah, I think there's just different things that you have to consider in today's environment than, say, the environment 18 to 24 months ago. And there's different strategies that you have to use. And interest rates are a big component to purchasing a business, but they're not the only component. So what Andy and I wanted to do today is first, let's talk about some implications on buying a business in today's interest rate environment. And then we're going to give you some strategies to think about when you're looking for deals, you're looking for partners and negotiating the terms that maybe can help make you feel more comfortable in this interest rate environment that we're in right now.
Yeah, I mean, so let's talk about the implications first, right?
Yeah.
Number one, it's just more expensive to get a loan. I mean, it's just more expensive to carry that loan. If interest rates go up 4% or have gone up 4 or 5%, maybe even 6% now, 6% on $1 million loan, that's an extra 60 grand a year. That's a lot of money.
Yeah, it's a lot of money. And that also has a further implication is it's not just more expensive or the interest or the payments are higher, but it can be more difficult to qualify for those loans. So the lenders are going to look at this debt to income ratio. And as the payments go up, you're going to need more cash flow to pay for that. But they also could have stricter criteria with the loan applications themselves. So that's not always the case, but we can see that in this type of environment.
Yeah. And a lot of people are trying to do things that are even, to get around them. So they'll lower the term of the loan if it's a seller note or something like that to try to maybe just, hedge their bet that it's going to go up later. But, a shorter loan may be harder to carry as well. I mean, so we're seeing a lot of things that people don't want to carry a lot of money right now.
Yeah. So if we look at that, it can be more expensive with the higher interest rates, more difficult to qualify for, and the terms could be shorter, making it more difficult to pay back the loan. The value of the businesses, they could come down, right, Andy? Because you need to carry more of this financing burden by the buyers moving forward. So this affects a lot of the typical popular types of financing like SBA loans, but it also affects seller financing too.
Yeah, I mean, everybody loves their spreadsheets, right? So they're going to do a business model and they're going to put in there the debt service coverage ratios that are needed to service the debt, be able to bring the return to a level that they want. And what's going to happen is that the value of the business, the ability to leverage that business is going to come down. So, but the good news out there is that the banking industry is certainly not in the shape it was in 2010, 2009. People still want to make loans.
Yeah. Yeah. And not only the banks, but we've also seen a higher interest level in sellers for seller financing, right? Because now they're earning a decent interest rate that protects them on the risk. So seller financing is still always the most utilized option by buyers purchasing a business. But now that the interest rate is negotiated privately, but being set by those banks, there could be better rates for the buyers, but also the sellers have some upside on that too.
Yeah, there's plenty of ways to leverage into a deal still, especially profits are still good in businesses, so they are still leverageable. The banks, the SBA is not running out of money. They haven't announced anything like that. It's still one of the most profitable things, or probably the only profitable thing that our government does. It's it actually covers its own costs, the SBA program. So I think this is still good news. But people aren't used to this. We talked about this a little bit before, and we'll talk about it at the end. People aren't used to these high interest rates right now, and they're getting used to them. And everybody's kind of jockeying for position to figure out what's it going to do to valuation, what's it going to do to coverage ratios, what is it going to do to my future cash flow, and everybody's just trying to hedge their bets. So we have a few strategies to consider.
Yes, and this is, I think this first strategy is the most important not to forget, is compare your different financing options. So we mentioned SBA and seller financing, but there's lots of different financing and funding options. And it's really important to determine which option best meets your needs for a business purchase. And also remember, you can combine things. So we didn't talk about the ROBS program, but the rollover for business startup. I think it's less commonly used, but it's a program where you can invest your retirement funds into acquiring a business. You can use that with some seller financing, some cash, and just really comparing all your different financing and funding options before you make that decision on how you're going to purchase the business. And I think we'll get into some other strategies of professionals that can help you build this deal stack. But there's so many different options and so many different ways that you can layer them together to make the deal work.
Yeah, there's definitely different ways to go out there and find financing. So one of the first things to do is consider a variable amount, rate loan. There's plenty of banks that are willing to do that. And some of them even have like a short-term fixed loan, say over the, next 5 years. So that'll bring down the rate. And I think I saw one recently for like 6 or 7%, and then it becomes variable in 5 years. And what you're doing is you're just hoping that interest rates, come down over the next 5 years, which a lot of people think they will.
Yeah, exactly. And I think third strategy is something we forget, but it is sometimes possible to negotiate those interest rates and payment schedules. Now, it could be difficult when dealing with some banks, as they do have some rules and underwriting policies that they do have to follow. But like we said, there's still plenty of money in the lending environment to purchase businesses. So you're still able to negotiate some of those terms, especially with seller financing, right? So the sellers can negotiate whatever terms they deem appropriate and make sure that that payment schedule works for the business, because obviously the sellers want the business to continue and run well as well too.
Yeah, especially seller loans. I mean, if the seller's insisting on a higher interest rate, which they don't have to, they're not the bank, they don't have to follow the Fed rate. They could still do 4%, 5%, 6% on their business, but there can be a balloon note at the end. There could be interest only for the first 2 years while you get your legs under you. There could be contingent notes. We've seen all kinds of things go into different ways. Earnouts. There's plenty of things that you can negotiate in a loan with a seller. And like you said, even the buyers. Now, the SBA program has to follow the rules of that. Yep. But there are certain things that they could do. Working capital loans, loans outside the SBA. Seller notes may have to be on standby, but there's lots of things going on there. And I think you did just really earlier mention the ROBS program. I like that program.
I love that program. And I think it's something we don't think about, especially like, look, everyone considering what's going on in the macroeconomic environment, they're talking about the market and should you invest your money in stocks or bonds or treasuries or whatever. Here's a way that you can invest your retirement savings into your own business, right?
Yeah, it is a program. And I would highly recommend that you use someone like Benetrends,
yep,
who has been doing this year after year. And there's certainly ways that it has to be set up, and it's best, ask somebody who you're working with at Transworld to hook you up with Benetrends or one of the companies that are doing that. But there's certain IRS rules that you have to watch out for. But again, there's no interest rates involved because you're borrowing the money from your own retirement. And guess what? You get to pay it back into your retirement and put some of the profits into your retirement. there's a lot of things that are, really good about that program, and it's probably underutilized.
Yeah, I think, and great point about Benetrends. They're a great partner and they know so much about this program and some other ways to use your retirement savings for a purchase of business. So for our last couple strategies, it's all about resources and advisors that can help you through this process. So Andy, I love you were talking about seller financing and different ways you can structure seller notes and earnouts and things. And I think what some people don't understand about the business brokerage industry and selling businesses, it's actually a very creative industry, right? You can put all these different deal pieces together, but you really have to have the right professionals and right teams and resources on your side. We've talked about that a lot on this podcast. But the first is the SBA, the Small Business Administration. So even if you just go to their website at SBA.gov, they have a ton of online resources about their programs. You can even look and see there's SBA employees in each region that can help coach you through the different programs, introduce you to some of the lenders that provide those resources and provide those financing models that we talked about earlier. So even just going to SBA.gov is a great starting point.
Yeah, and we have plenty of SBA bank partners that we use here at Transworld, and three of them, Live Oak, New Tech, Huntington National Bank, are the top three. They are the top three lenders in the marketplace, and they do a lot of business, and they have a lot of great business development officers that we work with here at Transworld that can help you understand all kinds of choices. And like we said, sometimes they have different programs for different things. I mean, some of them specialize in certain niches. They actually like that. Some of them have 100% financing for medical. I mean, there's a lot of ways that you could leverage those banks because, some of them they don't even have branches. I mean, New Tech and Live Oak are, SBA lenders that they're non-bank. Oh, actually, sorry, New Tech just bought a bank. So we're going to learn more about that soon.
Yeah. Well, and what's interesting about that too is like when you think of big banks like Bank of America, Chase, like they're not on that top 5 list of SBA lenders. There's banks that specialize specifically in these types of programs. So those are some of the 3. And then I think the other resource that's really good to find those specialized banks, credit unions, lenders with SBA and other programs is utilizing loan brokers. So loan brokers help you choose options for financing. And the nice thing is they're able to shop your loan for you and find you the best deals. And some of the partners that we work closely with at Transworld are Multifunding, Business Capital, Main Street Funding, and Diamond. And they can be really helpful in placing and really developing a competitive marketplace for your loan.
Yeah, the people that work there just are magicians sometimes. And you know what they know? They know small little banks that might want to play in certain, again, industries and might overlook things like business experience because they might be a little less stringent on that, and they might be less stringent on something else, or they might have another program where they want to be in certain marketplaces. There's, all these banks sometimes are getting into the SBA business for the first time and they have a big appetite. The brokers know all that stuff. So that's to go to those guys is a good thing to do.
Yeah. And our last resource or partner you definitely want to have on your team, Andy, is
business brokers. I mean, there's 700 plus of us here at Transworld. We're doing deals all the time. Just reaching out to us sometimes and just asking us about certain deals, even if you're not using Transworld, I hate to say that, but even if you're not using Transworld and you want to reach out to us and say, I'm buying my family business. Do you have any resources that can help me lend on it? It's like, wow, we've sold, 15 of that type of business. We know the banks that were involved in that type of business. We could probably get you to the right person and help you structure that deal if you're buying it, through family members or you're an employee buying it out. We love deals like that. We would be more than honored to help you because you know what? Maybe you'll sell one day and come back to Transworld.
Exactly. I mean, I answer those questions and those phone calls every day. And if anyone's listening and wants some connections to some of the resources we mentioned, just go to the dealboardpodcast.com. You can fill out the contact us form and just throw a note in there. Here's where I need help. Here's where I need assistance. And any one of us is happy to help.
So as high as interest rates are right now, we both feel that this is where they should be. I mean, maybe a little high. Let's call it a point or two higher, and it may very well go up. They just announced today, the Fed said that they're going to raise interest rates. They're trying to cool down the economy. The economy is cooling down. It's just lagging, as we're going to talk about in other podcasts. As we talk about commercial real estate, as we talk about the business valuation, it lags a little bit, but we both feel that interest rates shouldn't be 2% or 4%.
No, and it's not normal. Like I pick on my little sister a lot, but she keeps telling me, she's like, all right, well, I missed the first go round. I'll buy a house now and I can get 2.5% when interest rates are back to normal. I was like, James, that's not normal. Like that was a very short-term thing that happened. And I think a lot of us have forgotten about what a real healthy interest rate environment is like. And if we look back to 17, 18, 19, like we weren't in 2% interest rates. That just wasn't happening. So
yeah, and in 8, 9, 10, 11, they're trying to, get everybody, and they're holding those interest rates down as low as possible. And they were artificially held down low, and really we're paying the price for that right now. Inflation is out there because there's a lot of money. And why is there a lot of money? Because it was cheap. And money should cost money. And what we're seeing, and what I think has happened over the years, and the reason why baby boomers have held on to their businesses so long, and we've talked a lot about, people being healthier and all that kind of stuff, but where were they going to put their money other than a risky stock market, which, over the years, if you did that, that would have been a good move. But back in the day when interest rates were normal, and let's call it, you took out a home loan, it was 6%. You took out a small business loan, it was 8%. You took out a seller notice. And then if you wanted to take the money that you made from a business and put it in a CD,
you
could get 5%, 4%. Or you bought a bond and you could get 6 or 7%. And if you cashed out for $1 million and had a little bit of savings and had passive income of $70,000 to $100,000 a year through some reasonably safe investments, that was a good reason to get rid of your business.
Yeah. And if we think about a lot of like the baby boomers, they're entering retirement, so they want those safer investments, right? So yeah, we have seen some of them pull back and not list their businesses for sale, which we've talked about affects supply demand, and then that affects valuations and all of that. And also at the end of the day, like I think if we go back and we look at interest rates, even where they're at right now, and we think about the opportunity of income you earn on a business, it's still a really good ROI on that interest rate, right? In order to acquire a business that provides you a good income, good lifestyle to your family, why those sellers are holding on to that business, right?
Yeah, I think what we're going to look back on this time as another opportunity. We always want to take the Wayback Machine and say, oh, if we only knew in 2009 and 10 to buy all the land and all the homes that we could have bought on the beachfront, we would be millionaires by now. This is going to be an opportunity where it becomes scary, right? The unknown is scary. People who are not entrepreneurs shy away. The professional money might step out of buying some mid-sized businesses. This is an opportunity for you, Mr. and Ms. Entrepreneur, to come out right now and buy a business, get that variable rate loan, leverage your ROBs and your in retirement account, get a loan that might be a little bit higher in interest. And then 3 years from now, buy that business at a reasonable price, good business, and then refinance later, and you'll look like a genius.
Yeah. Or make a ton of money and pay it off, right?
Right.
Yeah.
Because still you're buying businesses for 2 or 3 times. I mean, we're talking sub-$1 million EBITDA businesses selling still for 2, 3, maybe getting close to $1 million 4 or 5 times. If you're worried about interest rates over the next 5 years, by the time you're done, you could pay off the business already.
Yeah. Exactly. Exactly. So I hope that this gave you a good overview and maybe some more confidence to go forth and purchase a business in this environment. But you don't just have to take it from us. We have a great expert on today's show too. We have John Wahl from Live Oak Bank, one of the partners and largest SBA lenders that we mentioned earlier. So you're going to hear his side from it straight from the banker's mouth.
Excellent. It's going to be always a good interview with John. So looking forward to that.
All right, let's jump in.
Hey, Andy, do you know what time it is? It's time for our deal of the week.
Deal of the week. Sold.
Everybody, welcome back. And we are doing Deal of the Week. And we are talking to Joe DeBartolo from Trans World Business Advisors of West Florida. But Joe's all over the place. Joe is in Central Florida, West Florida, and he just closed a very nice deal. Joe, welcome. Tell us about the deal.
Yes, to close the deal I just closed was a 90-employee post-pension company down in Tampa, Florida. It was a 25-year-old company, 90 employees. Awesome deal. You know, it was good buyers and good sellers, and everybody was happy at the end of the day.
That's awesome. So tell us how big it was. Tell us what the price was.
The price was $3.75 million. The discretionary earnings on the business was over $1 million a year. It was a very, very healthy business.
Yeah, it sounds really, really good. And the buyer, what kind of buyer was it?
He was out of Minnesota. He owned a pool construction company out in Minnesota. He came down to Florida trying to get out of the cold weather, and he found a beautiful company that was the guys were ready to retire. The two owners.
Nice. Good. It sounds like good deals for good people. Did he finance it through the SBA?
No, he did not. He had his own financing, a conventional mortgage he went through, and he financed it himself because he just sold his pool company in Minnesota.
Very nice. Very nice. So it sounds like good deals for good people. And Joe, if somebody else wants to sell a business like that, how would they best get in touch with you?
I'll just give me a call and give me a call, email me, and I'm available.
Give him your phone number.
352. What?
Give him your phone number. Yes.
352-999-1815.
Excellent. Great job. It was a nice deal for everybody. Good deals for good people. Thanks, Joe. Appreciate it.
Thank you.
Welcome back to the Deal Board, everybody. And today we have a guest that's joined us many times, and we're excited to have him back again, John Wahl from Live Oak Bank. John, welcome to the show.
Thanks, Jessica. Always a pleasure to be on with you and Andy.
So today we're talking about, getting deals done in a high interest rate environment. And Andy and I went into some areas and topics in the intro, but really want to dive into the details with you with what's going on in the banking industry. Maybe we'll just start with that basic question. In general, what's going on in banking? You guys have had exciting. I think exciting is the wrong word. Like
tumultuous.
Tumultuous, interesting last 60 days. So what's going on in the banking world?
Yeah. So, earlier in March, obviously with the Fed taking over SVP and Signature Bank, where those banks, not because of their loan balances or their loan portfolio got taken over, but because their inability to convert their capital to liquidity. And there was really a run on liquidity with those banks because they couldn't access some of their longer term investments, be it treasuries or bonds or, the equity that they have in their loan portfolio. So there was kind of an overly broad concern amongst depositors, I think, across the U.S. banking platform of folks feeling that if they had in excess of $250,000, they needed to reassess that. They needed to make a flight, what they considered a flight to safety. So, since March 8th, you've seen over $150 billion of deposits leave small and regional banks to some of the larger big bank names out there, which is, not what the Fed wants when it comes to a competitive and product offering standpoint and having a bank that's in your community. So it's been unique. It's not like what happened during 08 and 11 with bad loans and commercial mortgage-backed securities. So it's been a unique time in the banking industry because it's not something we've seen in a bank run for decades. So
Mhm.
the good news, is we're starting to see some of that retreat. We're starting to see that now that knee-jerk reaction from business owners, deposits are coming back to some of the regional banks. There are products available to allow business owners to have FDIC insurance in excess of the $250,000, which is great. There's been no material change in most lenders' lending policy. Banks are still providing financing for individuals to be able to acquire businesses, and businesses being able to acquire and do roll-ups and grow their balance sheet and their portfolio. So it feels more calm this Monday.
That's good. That's good. Well, and also, like, with all of this tumultuous stuff going on, we also have the Fed, continuing to make interest rate moves. So talk a little bit about that and where we're at today, and what do you expect? I know it's gazing into a crystal ball, but like, what do you expect to happen in the next months to come?
Yeah, I mean, I think, if my crystal ball worked, I would be retired. But I think where we are at today, last week the Fed met and they did have a majority vote to increase prime, but only by 25 basis points. For the listeners out there, prime a couple months ago was down at 3.25%. We're now sitting at 8%. So you're looking at a pretty significant run up in just a few quarters. That a lot of that has been to try and curb inflation, of which a lot of your sellers are seeing in costs of goods, supply chain, all of that. And so, but there is a silver lining to this. One, we're likely at the top. There's still the jobless numbers are low, labor market's tight. They've ratcheted it up pretty quickly now that we're sitting at 8% on the prime rate, and 7A loans, which is the most commonly used product, can be priced at up to prime plus 3% variable. Now is definitely the market to be in a variable interest rate where you can take advantage of those downticks. Historically, if you look at prime all the way back to, the mid 1960s, every time the Fed goes through this steep increases, even back, between 2004 and 2009, it's followed by a scaling back of interest rates. So variable is a great place to be right now because we're at the high. I'm optimistic that we won't see more than 25, 50 basis points increase here when the Fed meets again in a few months. But it has impact people's purchasing power.
Mm-hmm.
In that same bucket, though, when you think of the Dow being down 20 or 30% between its high, we're seeing the same when it comes to business acquisitions. We're seeing that it doesn't by any means stop deals from getting done. You just have to have a buyer that might be a little stronger, a little more liquidity, might be willing to come in with a little bit more equity. The SBA allows up to 90% financing for a business acquisition, which is pretty high leverage.
Yeah.
When you think about it. And we are seeing on the from a seller and a transaction standpoint, sellers are willing to maybe get a little bit more creative when it comes to how the structure is put together. The SBA doesn't allow for earnouts, but it does allow for benchmarked seller carry notes, where maybe you're benchmarking it to future revenues or EBITDA multiples or things of that nature. So there are still a lot of tools to be able to bridge that gap, if there is one, between a lower purchasing power of a buyer and still a really strong demand in the market for businesses, under that, say, probably 1 million in EBITDA number.
Yeah. Yeah. And a lot of good takeaways in that. Like, one, it's, good news. And I think if I had to gaze into a crystal ball and I was retired too, John, I'd say we're at or near the top with interest rates, right? I think what the Fed wanted to do, slowing inflation, is, hopefully starting to take hold, but that's good news, right? For everybody, not just buyers. Also, I really do like the creative deal structuring. And to be honest, we saw multiples and valuations of companies go up the last few years when the interest rate and the cost of capital was just so low for buyers, right? It was the same thing we saw in the housing market, right? You just had this huge increase in some markets. So there's a natural ebb and flow, right? Another big takeaway, I love your point about variable interest rates, is their variable can be good. I think in a lot of people's minds over the last few years, variable was bad because it only could go up. But from here, it's almost like it could still go up a little bit, but it's more likely to go down. So really some good takeaways. Let's talk a little bit about, though, historically looking at, and the title of this episode is, how to deal with high interest rate environment. But historically, like where rates are at today versus where they've been over the last 10, 20, 30, 50 years, is using an acquisition loan still a good investment, still a good return on investment to buy a business?
Absolutely. I mean, when you look at historically where prime has been, we had an uptick back in, 16 and 18. And then prior to that, 2002 to 2006. Everybody's memory is really short. And they forget that, unless you talk to your parents that always tell you the story about buying a house.
Buying a house in the 70s for 18% interest.
20%. Yeah. So everybody always hears that.
Yeah.
But, when you look at what we're financing blue sky, we're financing goodwill, we're financing future cash flow. 99% of the loans we're providing for business acquisition are wholly unsecured. They are woefully unsecured and under collateralized. So we are financing goodwill, which has a high risk. And to think that your alternative options are equity dilution with having to bring in more investors, VC or capital, angel investors, that mezz debt, which was in the teens previously, is now in the higher teens. Thinking of an interest rate at, 9 or 9.5% is not that bad. You can still get a great return on your money. Look at what treasuries are paying, and anybody's return, obviously the risk is much higher than a treasury, but the return on equity is still really, really beneficial. And a lot of the businesses may not have had, price changes to, help with inflation. So I think there's, for buyers that are coming into businesses, there's opportunity to offset that higher interest rate expense. But interest, a credit card or home equity, I mean, those are even high rates right now. So comparative to other financing vehicles out there, the SBA 7A program is really still advantageous. We haven't seen, a decline in buyers, because of it. You and your brokers do a great job at, communicating the expectations to the sellers with where the markets are at today. We do the same on the buy side. So money's a little more expensive. Memories are short. There's still good deals to be had, and we're still financing them. We have not had any changes to our credit policy, given what's happening in the banking industry, and, still a lot of good deals being done.
Yeah. And I think that's a really good one to expand upon a little bit, John. It's just like, there's still ample capital looking for acquisitions, right? And I know you guys are doing tons of deals. So just talk a little bit about, what Live Oak's activity is as a litmus test for the industry. Like there's still a large appetite for deals like this.
Yeah, there absolutely are, and in a lot of different industries, you're starting to see probably some rebound and normalization, which is great. We've had COVID in 2020 and 2021. And so 2022 for a lot of companies is more normalized. And we're continuing to lend into, the majority of industries. Obviously, I think, you talked about mortgage interest rates, and when those have doubled too, they've gone from in the high 2s to 6%. And that impacts many industries within the new home, especially new first-time home buyers in those industries and some of those ancillary industries. So we're continuing to see a lot of activity. It's a little interesting because you're seeing some geographical rearrangement, I would say, buyers coming from certain states wanting to relocate where, there may be more benefit to the lifestyle and living. We see a lot of people, you and I are based out of Colorado. It's still pretty popular to own and run a business here. If you're coming from, some of the coastal states where taxes are high and things like that, we're seeing a lot of people be less concerned about where they're at now and be willing to relocate to run their business on a day-to-day basis, which couple of years ago, I don't think that was quite as popular as it is now.
Yeah, it's a lot. And I agree with you on that. It's a lot easier to market businesses nationwide on a relocatable basis or even move into the area. Just a lot of different migration patterns going on, which we don't cover on the deal board, but you can find some really interesting stuff online. So let's move into like some tips. And I want to split this into, we'll do sellers first and then we'll do buyers. In this environment, what do you think sellers can do to be more prepared for a transaction and more likely that the transaction goes through? Because I remind sellers of this a lot. If you are going to find a buyer that is going to use financing for the business purchase, which by and large, almost all buyers use some type of financing, right? You should at least educate yourself about this financing process. So John, what can the sellers do in preparation to ensure that this deal goes through for the buyer and obviously they get their money?
Yeah, I think where we're at from a timing standpoint, I think it's important to be able to have your 2022 tax returns completed. We're almost all the way through Q1, 90 days into 2023. So I think that is an important step. I think having current financials year to date is also important. And being able, if, the majority of the business owners that we work with use QuickBooks or, Netscape or one of those, providers for their financials, learn how to export and provide an annual P&L broken down by month. I think that's key because it really, not just does it show you trends, it shows your advisor trends, but a good borrower is going to want to know where you stand year to date compared to last year, and how did last year compare to the prior years, any seasonality, any cyclicality, things like that. So I think that is one of it. If you haven't, if you have the time frame and you haven't implemented price changes, given that costs have gone up, move forward with those sort of things. I think also in that same, labor and understanding, do you have key people? Do you have key relationships? Understanding those, because that's likely going to be a really early question coming from a buyer. But I would say the financials are probably one of the most key things. And recognizing if there's any specific risks that your business has, if it's concentration with vendors or customers or, project concentration, things of that nature. And just recognize that those questions are going to get asked by a good buyer. And, you and your team do a great job on, communicating with sellers around what to expect, what questions are going to be asked. And obviously for sellers to make sure they're, using somebody that specializes in their size of business. So,
yeah, I totally agree. And the financials, it's funny. It doesn't matter what's going on in the economy, what's going on in the marketplace. Financials are always the key driver for sellers. All right. So let's talk about the buyer side. Like, what can a buyer do to well prepare themselves to navigate today's banking climate?
Yeah. And I just recap on one thing. I mean, when you look at financials, always remember that SBA program is a cash flow based program. So we're looking at the ability for that business to repay the proposed debt. So with that said, buyers, it's very similar. One, get pre-qualified, understand that make sure that you're looking in the realm of what you can afford. Live Oak is happy to pre-qualify buyers, help to provide them a comfort letter of what they can and can't afford. Where is your down payment coming from? I think probably, what is your experience and what is your down payment? Do you have translatable experience for the business? Are there gaps that you need to backfill for the business that you're looking at? Understand what your own personal balance sheet requirements are. We see a lot of people coming out of the professional world that say, well, I can survive with only making X, but the last 5 years I've made Y, which is 3 times of X. So be realistic when you look at what you need to take as an owner. Understand where your equity is going to come from, if it's all from yourself, if it's from investors, if it's from family and friends. There's a lot of resources or a lot of sources of equity, not just your personal balance sheet, that's acceptable to the SBA. So I think those would kind of be some pointers that I would recommend to buyers. And there's a lot of great SBA lenders in the country. Not all of them specialize in business acquisition financing. That's something that Live Oak does do, but work with somebody that's a specialist in this realm, so.
Yeah. And that's what I was going to add to that if you didn't tout yourself. But what Live Oak does really well, and why we love partnering with Live Oak, is they specialize in business acquisition loans using the SBA 7A programs and a lot of other programs too. But with our work together, it's usually 7A. But one of the big things I tell buyers where you can prepare is work with a specialist, right? Sometimes your bank is great as your business bank, as your personal bank, but they might not specialize in business acquisition loans. They might not even specialize in SBA loans. And I know the rankings just came out a couple months ago on the top SBA lenders in the country for 2022. And I think Live Oak was number 1, right?
We were, yeah, by a pretty good margin. This is now our 5th year that will be number 4th or 5th that will be number 1. And, we're pretty focused on doing one thing and doing it really well, which is SBA financing. That's how our bank was founded back in 2008. And so we continue to take that forward. It doesn't have to be painful. And so I always remind prospective borrowers that if you hear horror stories, it's probably because that person worked with the wrong lender. Our average closing right now is taking 42 days from beginning to end. So I don't even know if you could do a home mortgage that quickly these days. Some of the requirements. So, it helps to build trust in the process, which is important, I think, on both sides, building that trust, because when you go to transition the business, you want to have the full faith and the confidence from the seller that you're going to take their baby and treat it well, and their employees and their customers and all of that. So,
yeah, I agree. Well, John, it's been great having you on the Deal Board. We always love when you join and give us these updates from the banking world. Tell our listeners once again how they can reach you if they want to learn more about what you and Live Oak do.
Yeah, absolutely. Again, John Wahl with Live Oak Bank. You can call me directly at 303-551-4453, or my email is john.wahl@liveoak.bank.
Awesome. And we will drop that contact information into the show notes as well. John, thank you for being on the Deal Board.
Thanks, Jessica. Always a pleasure.
Hey, Jessica, you know what time it is?
Money time?
Almost. It's time for Listing of the Week. Hey, welcome back, everybody. It is Listing of the Week, and we are here live in Fort Lauderdale talking about listings. But interestingly enough, this listing is not on the mainland.
It's one of those American dream properties, right? This is located in the St. Thomas, U.S. Virgin Islands. So you're still in America, but you're not.
Right.
Everyone speaks English. Everything's on the U.S. dollar. This is a charter company, a sailing yacht, 44-foot vessel, owned and operated by the husband and wife who were looking to relocate back to the States for family purposes.
Right.
The company itself has been around for 20 years. The price of $299 includes the yacht, which is surveyed at $200,000, plus another vessel, plus all the brand new sails, plus it includes the mooring at Red Hook, which is one of the hard to find moorings of the Caribbean islands. It's a secured area. That's valued at $25,000 by itself.
Nice.
And the business actually makes money. They're making about $50,000-$60,000 a year in profit.
Right.
Okay. So,
but it's a lifestyle business.
It is a total lifestyle. If you want to sit back and live aboard your boat and make some money and just enjoy.
Do they live aboard it?
They do live aboard it.
Well, all right. So room and board included.
Room and board included.
It's an amazing opportunity. You have done a lot of offshore deals, although this is sort of offshore, but still here in the
literally
United
in the
States.
water. So
right.
It's literally not as offshore as you're going to get.
But it's not in a foreign country.
It's not in a foreign country.
So that's
St. Thomas, U.S. Virgin Islands, sailing vessel, $299,000.
Well, get it quick. It is one of those things that you made your New Year's resolution and you want to change your lifestyle. This is it, folks.
Just got to know how to sail. Either that or find yourself a captain.
Or learn real
Learn
fast.
to sail. Learn to sail.
Your first few weeks will be on YouTube
Right.
watching.
Absolutely.
So,
Absolutely.
all right, Tom, what's the best way to get in touch with you?
Tom at tworld.com or 561-702-6867.
Excellent.
Thanks, Andy.
Thanks, man.
Thanks for tuning into the show today. If you like the podcast, share it with your friends on social media. And don't forget to subscribe and leave us a review on your favorite podcasting app. If you have questions, would like to appear, or have suggestions for topics for the show, get in contact with us through our website, thedealboardpodcast.com.